Short Exercise 22-11 Cash Budget. Villalobos Company has $12,500 in cash on hand on January 1st and has collected the following budget data. So we can open up the budget data here. Assume direct labor costs and manufacturing overhead costs are paid in the month incurred. Additionally, assume Villalobos Company has cash payments for selling and administrative expenses, including salaries of $50,000 per month, plus commissions that are 1% of sales, all paid in the month of sale. The company requires a minimum cash balance of $10,000. Prepare a cash budget for January and February. Round to the nearest dollar. Will Villalobos Company need to borrow cash by the end of February? So here for the first requirement, begin by preparing the cash budget for January, then prepare the cash budget for February. Complete all input fields, enter a 0 for any zero balances, round all amounts entered into the cash budget to the nearest whole dollar. So over here in the budget data, we have sales, we have cash receipts from customers, then we have cash payments for direct material purchases, direct labor costs, and then manufacturing overhead costs. But this includes depreciation of $1,500 per month. And now remember, depreciation is a non-cash transaction. And since we're working with a cash budget, we will have to back this $1,500 out when we get to the manufacturing overhead costs. So when we break this problem down, this assumed direct labor costs and manufacturing overhead costs are paid in the month incurred. In other words, these are direct labor costs of $44,250 paid fully in January, and then $52,650 paid fully in February. So none of it's carried over to the next month. And that's the same with the manufacturing overhead costs. That $25,140 in January is fully paid in January, and the $26,540 is all paid in February. However, again, I need to repeat that that does not include the depreciation, since depreciation is not, there's no cash involved in the depreciation. But because this is included in the manufacturing overhead costs, to calculate the amount of cash that actually changed hands, we'll have to back that depreciation out of the manufacturing overhead costs. And we have some additional cash payments here for the selling and administrative expense, including salaries, all paid in the month of sale. So for each month, those will be allocated in the month that they were incurred. And then the company requires minimum cash balance of $10,000. So we'll see at the end of the month here, if we find out we don't have $10,000, we need to borrow some money to get to that minimum of $10,000. So we need to start with our beginning cash balance, and that's given to us here up in the words. So $12,500 in cash on hand at January 1st. So we know that's our beginning cash balance, $12,500. And then next up we have cash receipts from customers here. So that is given to us for $282,750. Go ahead and input that as well. And then add these through to get our cash available. And that's going to give us a total of $295,250. All right, and let's scroll on down. So it looks like next we have cash payments. So purchases of direct materials. That's given to us here in the budget data. So we have cash payments for direct material purchases for January is $73,253. So I'll enter that in. And now we have cash payments for direct labor, and direct labor costs are here for $44,250. So I'll enter that over and scroll on down. Now we have manufacturing overhead. So this is where it gets, again, a little bit tricky. We do have to back up this $1,500 of depreciation. So again, we're going to take what they gave us here in the budget data, this $25,140, and subtract out $1,500 of depreciation, because again, no cash is involved there. So that is going to give us $25,140, and we're going to subtract $1,500. and that is going to give us $23,640 for manufacturing overhead where cash was involved. So then next up we have selling and administrative expenses. So there are two pieces for the selling and administrative expenses. So up here it tells us that includes salaries of $50,000 per month plus commission of 1% of sales. So we have some calculations we need to do here. So first we're going to take 1% of the sales number for January, this 262,500. We're going to take 1% of that. So 262,500 times 0.01, and that is going to give us 2,625, and we'll add that to 50,000. So we'll go ahead and add 50,000, and that is going to give us a total of 52,625 for the selling and administrative expense for January. So we'll enter that in and also fix our manufacturing overhead, which again was 23,640. So now we can scroll down to the total cash payments here. So we will add these through these four cash payments. So that is going to give us a total of 193,768. And then we need our ending cash balance before financing. So what they're asking for is our cash available less the total cash payments. So let's go ahead and enter that through. So the cash we had available was 295,250 right here. And then we're going to subtract out the total cash payments that we made to see what our cash is afterwards. So it is 101,482. So that's our ending cash balance for financing. And then we have our minimum cash balance desired, and then that's that $10,000. So negative 10,000, since we will be subtracting this out. So projected cash excess or deficiency. So we are taking 101,000 and subtracting out that 10,000 minimum balance that we want left over. And so that means our projected cash excess, since again this is a positive number, is 91,482. So this is the amount of cash we have above this threshold that we're trying to stay above. So since we are above that threshold and in the black here in the positive, what are we borrowing for financing? We are borrowing nothing because we do not need to borrow any money to stay above this $10,000 threshold. And also because we are not borrowing any, there are no principal repayments here, so this is also 0. So the total effects of financing are 0. So then what does that mean for our ending cash balance here? It means it remains the same. So this ending cash before financing, it'll stay the same since we are not financing anything. So that's going to be 101,482 for the ending cash balance. So let's go ahead and minimize this and close out of this so we can check our answer for January. Well done. Okay, now we get to do February. So we have our beginning cash balance for February here first. Notice it is not included up here in the information. It is actually part of what we just calculated. So the beginning balance is the ending cash balance of January. So that's that 101,482. And then we want to pop open our budget data again so we can have our cash receipts here. So we grab our cash receipts from customers for February for $290,375. So it looks like our cash receipts have increased slightly from January. So we have cash available now. So we add 101,482 to this 290,375. And that is going to give us a total of 391,870 or 57. So our cash available is looking great here, about $100,000 more than the previous month. Now we have to go to our cash payments down here. So let's scroll down, see what we have. So purchase of direct materials. That's going to be right here for $105,076. And then we have direct labor costs, and that is going to be $52,650 given to us here. And then again, our manufacturing overhead costs, the tricky one, we have to take $26,540 and subtract out the depreciation because again, no cash is involved with that depreciation, and this is a cash budget. So we will go ahead and input that amount here. So we can do the quick math. So that's going to give us $25,040 for manufacturing overhead, or things like the plant property tax, plant depreciation, and depreciation on the machinery. So those are included in the cash transactions, except for that depreciation of $1,500. And then we have our selling and administrative expenses, so we can get our calculator out for that one because we're going to need 1% again of sales for part of that. So we know that we have $50,000 per month for the salaries, then we need 1% of sales for the commissions. So we're going to take 1% of $306,250 times 0.01. That gives us 1%, so that is $3,062.50, and we will add $50,000 to that amount. And for this one, we also want to round to the nearest whole dollar as well. So this is going to get rounded to 53,063 and not 0.5 there. So 53,063. And again, that was given to us in the beginning of the problem that we want to round to the nearest whole dollar. So we want to then add our total cash payments. So these four numbers, the direct materials, direct labor, manufacturing overhead, less the depreciation, selling and administrative expenses. And that's going to give us total cash payments of $236,629. So now they want to know what our ending cash for financing. So that again is the cash available here that we calculated, and less all the total cash payments. So that's going to be $391,857. Subtract out total cash payments of $236,629. And that's going to give us a total of $155,228. So we'll enter that in here for our ending cash balance. And so then we want our minimum cash balance desired again, and that's the same at $10,000 that we were given before. So we want to have at least $10,000. And then projected cash excess or deficiency. So do we have an excess or deficiency here? Well, we have much more than $10,000 in our ending cash balance before financing, so we have an excess of $145,228. And again, how I got that number is taking out that $10,000 threshold that we want to meet from the ending cash balance before financing. So then what does that mean for our financing here, our borrowing and principal repayments? We don't need to borrow anything. So that means this is going to be a 0 for borrowing. We're not repaying anything because we didn't need to borrow anything. And so total effects of financing are 0. So again, it's going to ask us for our ending cash balance. And so it's this $155,228 because again, we didn't need to borrow anything. So the financing didn't have an effect on our ending cash balance here. Perfect. Okay, so let's go ahead and check our answer. Fantastic. So now will Villalobos Company need to borrow cash by the end of February? You can see here our ending cash balance. We have much more than $10,000, which is our minimum cash balance required, so we do not need to. Will not need to borrow cash by the end of February because the ending cash balance before financing is greater than the minimum cash balance required of this $10,000. Let's go ahead and check our answer. Excellent.